please put your hands together for our panel. I'm going to start things off, and John, I have a question for you. How have you been finding businesses and the construction industry generally? Have you been noticing any trends with your customers in residential and commercial?
I think it varies from state to state. Obviously, Queensland is booming in the residential market today and will probably continue to grow, although we have some headwinds with after the election. I think we'll see the Olympics start to take off, which is going to put pressure on wages. If we get another storm here, then that will cause some significant disruption, and we may go back to what we saw 4 or 5 years ago. Sydney probably is a basket case and isn't going to change too soon. I think the northern part of New South Wales, Newcastle up, is still growing, but isn't to the extent it was in the past. Melbourne, probably today, we've seen a bit of growth down there, but that was more so around builders bringing jobs forward because of changes to the NCC. So we see the Victorian market probably has work to go for the next 12 to 18 months. But from everything we're seeing from builders down there, there's going to be something, I'll say 50% downturn in housing built in Victoria. We're seeing a lot of migration move to Queensland. Adelaide seems to be staying strong. It's not going up nor down. It always seems to stay fairly steady. Perth is obviously booming at the minute and will continue to grow. They're building roughly 25,000 houses a year over there. They've got a strong economy and that will continue to grow. I think probably the challenges going forward are, I don't know if anyone read, but 2 days ago the IMF brought out a report saying that Australia was the worst performing country for inflation. That the rest of the world is really coming out of inflation, but because of government spending here, our inflation still causes a big issue. So that means I don't think we'll see interest rates cuts for, I'm a pessimist, for 9 months. I don't think we're going to see that. So that's not going to, in a way that's good for us in Queensland. It won't bump us into where we don't want to be, but I don't think you'll see a lot of growth in the southern markets for a year to two. So generally that's where we stand.
And thanks, John. Would you say that there's still an aftermath of the COVID effects being felt across the industry? I mean, Patrick mentioned it before that we don't really talk about COVID too much anymore. What are you saying?
Look, I don't think we're seeing, most of the pain I think has gone out of most builders. We're seeing that where you had people suffering, I think most of those contracts are gone now. We're seeing some change obviously with the Japanese starting to buy more builders. So you've seen Metricon sell recently. We think Asahi will probably buy another couple of companies in Australia. So we're starting to see some consolidation in that. So from a credit perspective, the more the Japanese owned builders in Australia, the less risk you're going to face from bankruptcies or insolvencies. But it's going to be interesting to see where the Japanese go, or do they stay in the market, I suppose.
And what about you, Rhys? How are you finding things at present?
Yeah, I think it's a real mixed bag. Like John said, geographically it's very different, but also in the type of work you're doing, what type of construction. I think from a volume home builder perspective, it's the large volume home builders have settled down with international investment, but I think small to mid there's still some concerns. Definitely renovation and repair market is really quiet because that's a real discretionary spend kind of space. So for us that's really down. I think whilst the fixed contracts in new homes have sort of flushed through, there's still quite a few loss-making jobs going on in the construction sector and in large commercial projects that are still coming through, and they're still causing pain for some large construction projects. And I mean, there's a lot of pain out there. I was talking to a civil contractor who was developing a housing estate in Goulburn, and for example, the prices of lots that have been sold that they're about to develop have just become uneconomical. So they've just closed the whole complete stage that they were going to develop for housing that's now not going ahead. So there's still a lot of pain, I think. But seeing things from a credit point of view, I think, like it's been mentioned today a few times, generally our debtor book is good still. Overall collections are good, overdue percentages are really low and have been now for some time.
Pain's an interesting word to use. Speaking of pain, I know these cause you a fair bit of pain, the ATO defaults. How has that impacted your business?
Yeah, it's probably easily the single most biggest issue at the moment. Going on the stats that Pat just had up, 26% being in construction of around, 33,000 or something. That's 8,000-ish. We probably have about 2,000, so I reckon a quarter of those are customers of ours. Today we had somewhere close to 20 new defaults. So Wednesdays are a real scary day. I start my day by looking at Risk Watch and scouring down that list for new insolvency appointments and SBRs, and then by about lunchtime, Pat's email comes through with the new default listing, and we quickly scour through that for how many more new ones. It's not unusual for us to get. We've had a week where we've had 50 before, so it's a real challenge to work out how we navigate those and how we play a part in keeping the economy going, but also managing, mitigating risk at the same time.
Yeah, I was going to obviously ask that as to whether you've seen any trends between the defaults and the behaviour of your customers, and then how you've had to, deal with that risk mitigation, and what different strategies you've put in. I know you've had to put people on the problem. What else have you done?
Yeah, I could talk about this all day. Trends, at first we were seeing lots of defaults and not a lot of activity subsequently, insolvencies, we'd see defaults and then payment plans, nothing happened, but we're really, I think Pat talked a few weeks ago about something like 33%, is that about right? Yeah. Of defaults are now subsequently becoming insolvencies. It's still very early, but we're really seeing that as well now. We're starting to see, tying back into the ATO presentation, a really interesting stat was that she said something like less than 50% of plans that are longer than 12 months fail. And so, we're seeing a lot of defaults come on, payment plan gets entered, default disappears, and then subsequently they either default comes back or the company goes into an insolvency. We've had to really work out how we manage those. Generally, if it's a small amount under 20 grand and they've got a default, we kind of just park them and make sure they can't trade any higher. And then larger ones, it's really a detailed discussion with the customer, and I know people do them differently, but you've really got to get to the bottom of, why the customer got there, how the tax debt came about, what they're doing about it. Is the payment plan they've entered into sustainable? Because just because the default gets removed because there's a payment plan, I've got a customer right now who's on a payment plan of 150 grand a month. Now, I know most of you work in this industry know that no matter what real size, in our case a plumber or a builder is, not many of them are making 150 grand profit a month, right? So you can see why that stat is coming about, that after a period of time, the payment plans are sort of falling apart. So it's something that I could talk about for a long time. Hope that answered the question.
You did.
One thing I would also say, and another trend is that, just a quick point, is that we're seeing a lot of people, a lot of our customers telling us that they're being advised to, get to a certain point of tax debt in order to be able to roll into an SBR and then deal with the ATO. And the ATO, we're being recorded, aren't we?
Yeah.
The ATO seem really proud of the fact that they're signing off on 90 to 95% of SBRs, which is, I find quite interesting, because businesses are almost playing them for a fool, because they're increasing their tax debt in some cases to a point where they're being advised what the sweet spot is. Then they roll into an SBR, and then people like Andrew will go and negotiate, and then the ATO is proud to say that they sign off on a 20 cents in the dollar deal. So it's I'm not sure SBRs were created for this reason, and it's an interesting topic moving forward.
Yeah, I think from a legal perspective, and what we've been seeing as, I guess, the impact of the activity of the ATO and things, it certainly has created a flurry of, wind-up activity or appointments of people like Andrew. But in the last couple of months, and Nick would probably agree with me here, we've seen a bit of a settling down, I suppose, of legal action being taken by our clients. A few months ago, it was crazy. The new instructions that were coming into our division were, some of the highest new instructions we've had, where it's sort of levelled out. But I guess the types of matters that are being referred in, or the activity that's being taken, seemingly a bit more complex. Like the routine type run-of-the-mill debt recovery type matters have got a lot of bits and pieces on them now, and it's I guess things are coming through, and it's obvious that they're disputed because there's issues with cash flow or things that are happening between the businesses, or it's legal actions coming in, but it's attached to an insolvency, and the type of work that we're doing is not just trying to recover the debt, but we're giving advice and things around creditors' rights, within that insolvency. So I suppose the flow on to that shifting with the action of the ATO is, I guess, impacting the work that we're doing and the legal action that our clients are taking because of that unrest, I suppose, with business.
And as a supplier, is there any suggestions or things that we can take away to mitigate the risk before we hand over files to you so gratefully?
Yeah, look, we always know as credit professionals, and something Nick and I are always on about, is making sure that, I guess, that you're setting up that customer from the beginning the right way. Just because there's a bit of unrest or uncertainty in the market, we shouldn't, throw away our good practices. And it starts at that very beginning of, how you open that account with that customer and making sure you're aware of who that customer is and, that legal setup, making sure you've got agreements in place, making sure if you've got the ability to register your PPS that you're doing that, immediately, and making sure you're covering those bases. And then it's just being, I guess, proactive, and it's so basic. If you put the legal framework in place and you've got good process, good credit management process, and then you're alive to what's going on with that customer, you can, I guess, monitor things, whether it be via alerts or just understanding of people talking to your customer, what's going on, and then you can move quickly. It's often that, we're being instructed, for example, if there's concern or question marks over a particular customer for one of our clients, we might, register a caveat, for example, just to protect that trade and make sure that the client has comfort for ongoing trade. Or, we might be, preparing additional documents and picking up additional guarantees or something if there's concern or risk over what's going on with that customer. But it really does go back to the basics of setting up that contractual framework well. So in the event there is risk or concern, you've got levers to pull, and those levers, depending on the type of business that you are, will either sit within like the PPS realm, or it'll sit in, picking up additional guarantees, or, a cross guarantee from a related entity, those types of things. And then just being really proactive in understanding exactly what's going on so you can move on it quickly. And that, like the caveat registrations, I mean, every other week we're settling matters in relation to where our clients have got caveats. And properties are being sold, we know what's happening in the property market. So being able to do that as a supplier to then be, paid out and move on through that type of security is something certainly we would encourage. Andrew, what about from your perspective? I'm usually giving Andrew, or the likes of Andrew, a hard time. I should have said from the start that he is one of the good guys. He is a creditor-friendly IP, if we can say that. But from your perspective, what are the ATO defaults doing? How's it influencing the solvency of businesses that you're obviously getting inquiries from, the consents that you're getting? Like, what is that looking like? And then secondly, when are these businesses coming to you for intervention and for help? I mean, every other day you're picking up new inquiries, we know that. What are you seeing?
Thanks, Anna. Obviously, I'm going to lighten this a little bit, given we're getting into some pretty heavy territory. I feel a little bit inadequate based on the two introductions that you both had. It felt like we went 5 minutes each. I'm lying here on the side going, oh, hang on a second, when's it our turn? But in any case, coming back to the topic at hand, the default stuff has had a marked impact on the ATO has always been a big driver, particularly of formal appointments in my space. And going back to Pat's slides earlier, you can see that they've ramped up their court action, recovery action quite markedly, particularly in the last, I'd say from May last year through to now, so the last 12, 18 months. And that's definitely having a huge impact on people that are coming to see me or having to engage me. Just in terms of the timing around that and when people are coming, anecdotally, the ATO has made it really, really difficult for people to enter into payment arrangements that are more than 12 months. And I guess that's on the back of the statistics about the 50% failure rate. So, for example, the other day I had a solar business that I'm now appointed to that had a tax default of $4.5 million, so a substantial amount. He tried to negotiate a payment arrangement with the ATO to be paid over an 18-month period, provide security over properties and all sorts of other things, and they wanted a huge chunk up front and then the rest of it paid off over 12 months, and it's just not something that, like you said, the 150 grand a month, sure you can enter into that arrangement, but are you actually going to be able to meet it? So that the change in direction that they've taken around that has definitely had an impact where people are coming to me earlier now because they can't get that first payment arrangement across the line because it's not feasible for the business.
Can I just make a comment?
Yeah.
In order for somebody to incur a tax hit of $4.5 million, and bearing in mind what the lady from the ATO said, a considerable portion of that is trust money. So GST, PAYG, that isn't their money. So they have taken money out of their employees' pay and spent it on whatever, for whatever reason. So,
Yeah, I'm not saying I have sympathy for people, and that was what I was trying to say.
We all hate the ATO, but the tax and debt are inevitable for all of us.
Absolutely.
And I sort of go, yeah, I'm getting a lot of defaults and it's a pain in the ass and I have to manage that and I'm responsible for managing my customers, but I'm sort of going $4.5 million in tax.
Yeah.
How many of your employees that you take tax on that you haven't done the right thing with the GST? And I sort of go, yeah.
So I'll give you some ballpark figures. There's super of about 800 grand that's not being paid, as long as an additional SGC interest and penalties and things that are on top of that. There's GST, there's PAYG. The core debt itself probably would have been about $2.5 million. But by the time you tack on the penalties, interest and the time, it comes to a big number. And you've got to think about how this has probably evolved. And it started to accrue in 2017, 2018, and then you get to the point where you obviously had the COVID period and the nil enforcement piece. So you got to think about that in the context of the recovery actions that were being taken prior to now. So I can see how that debt's obviously accrued to that level. And again, I'm not sympathetic to people like that because you're right, they should have been meeting their obligations, particularly their employees, but also to the ATO. I'm just saying that what's happened in terms of the change in the recovery action is resulting in these types of conversations and engagements for someone like myself. In terms of then what that looks like and continuing to look like in my view for the next, I guess, 12 or 18 months, I'm similar to Pat. I think that the enforcement action and recovery action is going to continue to be maintained to that level, even though there's elections on the horizon, etc. There's a real push to get that 55 billion that was outstanding 12 months ago down to a more manageable level, and that can only be beneficial, albeit have impacts on the economy at large, particularly with people being forced into circumstances where they've either got to try and restructure or effectively are placed into liquidation and the business wound up. So there's going to be some more pain from that perspective, in my view, in the next 12, 18 months, and I guess it needs to happen so that we get back to a point where we've dealt with all the pre-COVID, all of the COVID, and got back to a level where inflation is hopefully not a problem going forward.
Thanks, Andrew. And I guess with what you're seeing and the new inquiries and the appointments that you're taking, what would you say are some of the most common early warning signs that you're seeing, particularly within the construction space of these businesses? And, you know, how do you, I guess, advise everyone to see those, and then and what should they be looking for, you know, with dealing with customers like that?
Absolutely. You've got an amazing tool with tax defaults now, albeit it obviously increases the workload of you and your team in terms of having to engage with the customer and monitor their performance. That has always been an early warning sign for me, and it's something that you guys now have some visibility over. You don't obviously have it right at the start, but you do have it once they stop engaging or they're getting to a point where they shouldn't probably be in business in any case. So you're getting that a little bit earlier than you might ordinarily have got it, and it's information you can obviously get from people like Pat. So statutory lodgements not on time, non-payment of tax. Obviously there's super and PAYG and GST are now potentially personal liabilities for directors if they haven't lodged their lodgements on time. And that is something that I'm seeing a lot of in terms of the director penalty notice regime and those being issued for that purpose. The ATO's recovery action in that side, aside from the court stuff, is actually quite smart because they're using the Tax Act to ultimately pin personal liability on directors in circumstances where they haven't been compliant. So that's changing the behaviour from directors in that regard. So they are now being compliant, lodging things, which then means that you get the tax default because the ATO knows about it. So that can only be good for the economy overall. Other things are obviously payment arrangements. If you're being asked to take 10 grand a month for the next 5 months on a 50k bill, that's another indicator of potential insolvency. Those are really the avoiding calls, not responding to emails, all of the things that you guys would get. They're really the things that, from a credit management perspective, that are going to say to you, yeah, there's something wrong here, I need to dig a little bit deeper, or I need to rethink the credit terms, or I need to put them on stop, or I need to go out and visit them and see what's actually happening. So practically, those are the things that would start ringing alarm bells for someone like me.
And what about you, John? You know, with what's happening in the current climate, do you think it's easy for you to sort of preempt when your customers are having financial difficulty? Like, do you sort of, the alarm bells go off, or what happens in your business?
I rely on Maria for that. I think probably our biggest risk I see is that our customers are going to change over the next 5 years. How we build houses today isn't going to be how we build them in the next 5 years. So we're either going to go to factory build in Australia, or we're going to go to flat pack housing coming from places like China, Vietnam. And I think a lot of builders are starting to look at that now. Not necessarily builders. We're getting guys like Stockland say to us, okay, how do we go and build a new house? We don't want to do it the traditional way. Can you give us a flat pack house? How are we going to do that? I think that's going to be a dramatic change. So the people you deal with today as builders are going to be different, I think, in 5 years' time. I don't think we'll be building houses the same. We've seen massive change. That means the builders will no longer be the people you're used to dealing with. It'll be a totally different market. And we're seeing a lot of that, especially around land lease communities now, starting to take off, where we're getting people like Stockland move in, we're getting people like Mirvac, we're getting Macquarie Bank now starting to move into a lot of land lease communities. I think that's going to change home ownership to a degree. But I think there's going to be some massive changes around innovation that's going to come into housing.
And what about, I mean, there's been a fair bit of talk, you know, over the last period with respect to labour shortages in building and construction. Do you see that as a big impact at the present still, and what are you seeing in that space? And I guess from your own operations, your own workforce, like how is that labour shortage piece?
I think that's going to be a massive risk going forward. People don't want to be apprentices anymore, I don't think. Hard to get someone to be a brickie or a roof tiler, and also how we build is changing. So years ago, a timber would have turned up on site and a chippy would build a frame. Today it's a frame that's pre-built and it goes to site. So having someone do that for 4 years to get that apprenticeship isn't going to happen. We've got a shortage of trade in Australia, and that's going to get worse for us. So we're going to look at what the licensing regulation is going to have to change to deal with how we build houses in the future. So, as I said earlier, I think Queensland, we're in for a real labour shortage when the Olympic Games take off. So I think change in the industry, change in the trade people want to do is going to be a big impact, and it'll affect who we deal with and how builders, well, will builders still be here in 10 years' time?
And thanks, John. Rhys, you mentioned before that your debt book's looking pretty good, and I mean, you obviously have a good lawyer on your side. But I mean, what have you been seeing? Have you seen a delay in payments, like from an insolvency perspective with your customers? I know you've had a few, not a huge number. Like, what are you seeing?
Yeah, I mean, I found the last couple of years have been really hard because our debtor book has been so good, and I know, attending BRCB meetings, most people are saying the same thing, that our overdues have been quite good and low. So, typically we look to delayed payments to foresee an insolvency. And I know even in Pat's data, the construction overdues were, performing really well. So that does make it hard, and I think, a lot of the insolvencies we've had are popping up out of the blue where, there's something underlyingly happening that we're not aware of, and all of a sudden, bang, they're gone. And I suppose that's where it's really important that you do need a good lawyer and good paperwork at the start to protect you for when that does occur. But warning signs, I suppose, still are there. They're just harder to find in my eyes. Like, for us, it's just being more thorough, more customer meetings, understanding your customer more deeply, and understanding what market they play in, how much money they're making, what margin they're making on jobs. Sometimes I find with our customers, they'll tell me how good they're going, and I can say no. Once I've met them in person and I've had a good understanding of their business and whatnot, I can say, no, I don't like that guy, doesn't know what he's doing. It's just a more thorough, deeper process of understanding, and I know, when they're telling me they're making losses on this job and 1% on this job, and, I walk into their office in a mess and they've got no process. That's the kind of stuff, but that is harder to find, right? It takes time, it takes effort, but, that kind of stuff works. And then, the payment data is still there. We use all the alerts, we use, I talked to the AICM about custom scoring and credit modelling, using AI and data, and, with the help of Pat and his team, that's really helpful to us as well. Looking at how we can predict defaults on customers is something that we're turning to try and get an edge.
And would you say any particular states were more difficult than others? I mean, I know there's been a bit of an activity in Victoria on a few customers. Like, what are you seeing there?
Yeah, I think John probably summed it up and might know it better than me, but, for us, Queensland's going well, New South Wales is okay, Victoria's been really difficult, I think. The government's caused a lot of problems. There's just not enough work for the amount of players that are there at the moment. So Victoria's been a real struggle and almost a fight to the death for some of our customers, trying to win work at price points that just aren't viable. And again, it probably depends on what sector of work you're in. If you were in the new home space, you're in trouble. If you're in different markets, you might be going okay. But again, like John said, SA and WA going really well. It's a really hard question to answer when someone says, how things, because it's so diverse, and you have to take that into account. When you're looking at your customers and where you're dealing, you've got to understand what market they play in, where they play, what's normal for them, and seeing a customer that might. We had a great example that you worked on for us. A customer was in the apartment space, prefab, all prefab stuff, and all of a sudden, just after COVID, they got worried they weren't going to win any work, so they decided they were going to get into commercial construction. And they had no idea, no plant, no equipment, no staff that could do the job, and subsequently fell over.
And would you say that your customer base are favouring any particular type of corporate procedure? Like, I know there's been a few SBRs. I don't think we've had too many administration. Like, do you think there's any, particularly looking at who your customers are, any process that's being favoured?
Yeah, well, definitely SBRs. Like, they're really the flavour of the month for reasons we've sort of discussed already. Not seeing anywhere near as many liquidations or VAs like we used to. I think in our space, it's a real tax play, the SBR model, and just trying to write off past issues and carry on like nothing's happened. In fact, a lot of the customers will say, "Oh, we're profitable. If it wasn't for the tax debt, we're travelling fine." And you're like, okay. So yeah, that's where we see.
Yeah, I'd say, and with that SBR piece, certainly from the stuff I've been doing with you and your team, it is the flavour of the month, and I spoke about this at the AICM last week myself. I think there's a lot of misinformation out there with respect to SBRs on both sides of the fence. You've got obviously the businesses that are taking up that restructuring process that don't understand what they're getting themselves into. But then also I think as creditors, there's a bit of misunderstanding as to how you deal with the SBR, and there's a lot of confusion, particularly if you're sitting there as perhaps a secured creditor, and what that how that impacts the way in which you deal with the SBR itself. And I know certainly with the matters that I've been working on, for Reece, when I've been talking to these particular directors, for example, that I'm talking to them because Reece has security, and I'm talking to them because I'm wanting to sell their family home so they can pay Reece out because they owe all this money. They just don't understand what they're signing up for, and they think that, oh well, if I restructure, then everything will be fine. Everyone will want to trade with me again, and everything will be perfect. But the reality is that obviously there's concern over that retrade with that business once it restructures. From an insurance perspective, it causes problems because as soon as there's that appointment, the limits are dropped to nil, that type of thing. I mean, Michael can probably, from an NCI perspective, echo those comments. So I think, like, while there was the intention and while this regime was put in place from like a COVID mechanism, it is being now used for something other than probably what was intended. But then also within the space, I think there's misinformation and misunderstandings, as well. And like I've had some really, I call it frustrating conversations, even with IPs that don't know what they're doing. Obviously, Andrew's not one of them. But, I've had, for an example, where a client of mine was a secured creditor, and they had been included, and they had, it was actually a Reece matter, they'd been included, they shouldn't have been included, and I had to ring the IP several times to have them, obviously removed from it. And when they said that they were relying on the information the director had given them to include Reece into the plan rather than running a grantor search to see that there was an ALPAP. So, so there's a few bits and pieces that are happening in the space, and saying that there's been some success stories as well, for clients of ours that have had, they've been paid out prior to, or, paid out close to, and, the business has been able to retrade. But I think that SBR piece is, it's a challenge for everyone, and you really need to get across, firstly, who you are, as in, are you a secured creditor, are you an unsecured creditor, what are your rights, and then what does that mean for you in dealing with that customer moving forward?
Because I guess even in some instances, I don't know, I'm sure others have experienced it, but the SBR process can carry on, but you as a creditor could be excluded and continue to be paid separately, and we've seen some of those as well. Yeah,
for like the one which I just said, which Reece was excluded from, at the same time being excluded, the debt was 67, and I was able to recover 70 from the guarantor from payments that have come, unrelated to that company. So, when we're seeing that SBR process, or any type of insolvency process, you've got to think, well, what else can I be doing while this is going on? And of course, we all know it's a guarantee, having those personal guarantees from, either from individuals, or if it's like a, cross-company type thing, having that other avenue to be pushing at the same time and running in tandem with what's happening will mean that you're not sitting there taking 20 cents on the dollar. So, yeah. Pat?
Just on the SBR process, so post-SBR, what's the approach that most creditors are taking? Is it not to trade with them or to reduce credit? What's the sort of general approach? I mean, this is probably a question for all of you, but whoever wants to say.
Yeah, I guess it's individual, and I've spoken to lots of people who do it very differently. Yeah. Some people just seem to close the account and get out. Others ignore it. We just treat every instance on its own merits, and that's what takes time and is harder, because it takes time to understand what the customer's doing. A lot of the time the customer doesn't understand the process at all. They've been told by an accountant or someone that, this is just a way to clear my tax debt, I'm carrying on like normal, I'm still in control of my business. I guess you have to make your own assessment as to how they got there, whose fault it is, do you want to keep trading, do you want to enhance your security? But yeah, I've heard all sort of all sort of scenarios of what people are doing. Some people just rely on the insurance getting pulled, so they pull out. Yeah, I think it is. That's one of the most difficult things to do it, in my eyes, to do it properly and to give the customer that customised kind of service. That it takes time to get through that process and understand how it comes together. Even asking them, can you prove that you're in a payment plan? That by the time they submit it to the tax office, give you the paperwork back. It's that's a timely process. Yeah.
Yeah, I just add to that I do think that if I could say broadly speaking, a lot of people run for the hills once there's that restructure. And also from an insurance perspective, I mean, if you're someone who engages in credit insurance, it's going to cause you a problem as well. So again, when we go back to the intention of what this whole regime was put in place for, years ago because of COVID, it was obviously to help businesses, be able to rebuild and survive and, restructure and move forward. But the practical reality is, I would say, the bulk, and, Nick, correct me if you're wrong from your perspective, but I think a lot of our clients would be scared or hesitant to continue on when, a business has gone through that restructure without, if there was additional security or something picked up to balance it out, sure. But I think there's that general approach of, don't want to go near that business, unless there's something else.
And I think for sure, not all, but a lot of IPs don't understand the ramifications either. And I've had multiple conversations talking to them directly, and they'll ring and they'll be like, why won't you trade my customer? And it'll be a circumstance where I've done my due diligence and I don't want to trade them the way I was. And they just don't understand. They're like, but my customer's going fine, he's had this debt, he's wanting to clear it. Why won't you? They just have no idea. And so therefore the advice they're giving the company is awful, right?
And to add to that, Rhys, that's what we see at NCI, that they're getting a lot of pressure. I was talking about this earlier this morning, that they're getting pressure to say, well, open my account back up. They're getting actually fed lines to our customers with insurance to say everything's fine. Yeah. It's really a sales pitch to open my account back up. Yeah. But one last week, the ATO debt was $700,000 still. Yeah. So I just asked the customer, so is the debt still there? Is it a portal that's clear? Oh no, the debt's still there. Yeah.
They have this misconception, like I said before, that outside of that, their business is going well.
That's right. That's right. So they're getting. What I see is they're getting told the information. They don't know the ramifications behind telling someone with insurance, and obviously our customers get excited because they think, yeah, we'll trade again. Yeah. So I think it's definitely something we're wanting our way. Yeah. Sure.
Sorry, Reece. So are you saying you haven't supported a business under?
Oh, no, we support lots, but we just, every case on its merits, yeah. There's some where we don't like how they got to where they were and we don't think that they can get out of where they are, and so we don't support. But others, yeah, we support 100%, yeah.
How receptive are they when you approach them, whether it be an ATO cold flag or...
The customer? Mostly at first, they're very taken aback because a lot of them even think that an SBR is a secret. They think that it's like, I'm still in control of my business and nobody knows about it. Some of them will say, how did you know? And so they can be a bit taken aback, and like I said, they don't understand the process, so they don't know if they should talk to you about it. But I find that, a lot of the time we're, counselling them in some respects to say, hey, you should consider this, you should consider that. And they'll come back with a second and third phone call that'll be a lot more receptive to showing you more information or talking to you about how they got there, because they realise it's all going to turn to custard really quick if they don't have you or I or whoever else supporting them.
I suppose from your perspective, Andrew, I mean, you're doing the SBRs and you've been picking up a few more of them recently. Like, what are you seeing? And particularly with obviously businesses that you're working with in building construction, what would you say? I mean, there's with this misinformation piece that we're talking around SBRs, I think there's also a lot of pre-insolvency misinformation that's being given by people that are not credible, which is causing havoc. And there's costs that are being put on the businesses to give this pre-insolvency advice before it even goes to an IP to put them deal with the restructure and all of that. So there's all these people sort of putting their hands in the pies to try and take everything for this poor business that is on their death's door. Like, what do you think?
Yeah, good question. In terms of SBRs, I've only done one on a construction company that's been successful. And the main reason for that is because of the licensing issues that pop up for external administration appointments, and it's difficult to do an SBR in a construction industry, particularly if you're a licensed builder or have electrical licences or something of that nature that are affected by that external appointment. In terms of how am I approaching them, like you said, it's flavour of the month at the moment. There are people that are advertising it as a way to get rid of tax debt, and that's how they're getting people in the door, so that people aren't necessarily fully informed about the ramifications of it. And there's some misinformation about secure creditors. There's some misinformation about the insurance piece, and a lot of people actually didn't realise that ramification once the regime was brought into play, and that's something that's being talked about, particularly at my reader member level at the moment, as to how that's approached. And because of the fact that it's so new and lots of people are getting into it because it looks like it's an easy way to make a quick buck, it's unfortunately on you guys as the people that are affected by it to understand what your rights are. And that's not to say that the IP shouldn't already be telling you that and doing what they should be doing to advise you of those things, but in all practicality, they're not 100% across it themselves in some circumstances. So there's a good fact sheet on the ARETA website that I'd encourage you to download that talks to you about secured creditors and unsecured creditors and your rights around that and the process. So I'd grab that in the first instance, and then secondly, obviously I'm more than happy to answer any questions that someone like Anna can't answer in relation to the process, and it doesn't matter if I'm not attached to it, please ring me, happy to talk through them. From my perspective, I'm just treating it like what I would call a light touch voluntary administration. Whilst I'm not in control of the business, I'm effectively going into the same level of detail around reporting the voidable transactions and the preferences pieces. There's a little bit of nuance around that, but you've still got to report on insolvent trading claims, you've still got to report on the preference piece and the voidable transactions piece, and then you've got to make a commercial determination about future cash flows and what that looks like for the business going forward. And there's a fair bit of work that you have to do to get to that point. And coming back to the ATO piece and the 90 to 95% that Rhys mentioned, they're actually being a lot more diligent in the last month or two around making sure that they've asked me for capacity to pay details. They've said, well, have you looked at the profitability of the business previously, how the debt came about, what does it look like going forward, what are they changing to make sure that they can continue to trade profitably. And I'm getting pushback on some of my proposals to make sure I give that information, which is great because it means that they're thinking about it more deeply than maybe they ordinarily did at the start. And that I can only allude to my own experiences in that, because it's even new to them. They're struggling in terms of actually responding in time, and that's something they have to deal with from a capacity perspective as well.
And another one for you while we're on this point of insolvency, may as well ask the IP all the questions. When you have a construction company on the brink, what legal options do they have to restructure the debt? I mean, you touched on it then when you raised voluntary administrations, things like that. But what can they do to restructure, protect assets, and then negotiate with creditors outside of, I guess, the SBR process?
There's obviously the standard ones that you guys are probably know and don't love, but the voluntary administration process has been around since the 90s, and it depends on the jurisdiction as to what impacts that might have on licences and things, so you need to be cognizant of that. That's the main one from a formal restructuring point of view. There's also the safe harbour regime, so whilst it may not be for you guys yourselves, it's probably something that your customers, if they're getting into some sort of difficulty, might look to avail themselves of. But that's effectively if they're looking at their business and their profitability is decreasing and they see their margins are decreasing as well, but there's a bit of runway in that. They know that in 6 months' time they're probably going to run out of money, not tomorrow. there's the ability for them to engage a specialist advisor to look at changes within the business that can be made before some sort of formal insolvency appointment, which it might be getting out of the commercial space but knowing what you're doing going into your new space, or it might be we've got to cut some staff because our the capacity that we have is more than what we have in terms of our work in progress, and it doesn't look like that's going to change in the near future. It might be looking at your cost lines or your next contract. Perhaps we need to add another 5 or 10% to what we're bidding at, because we know that there's other things that might pop out of the woodwork that's going to affect our gross margins. So there's all sorts of levers you can pull, not necessarily in a formal circumstance, that if you've got enough time and someone like myself's got enough time to come and analyse the business and there's money to do things, that you can obviously go from down here to back up here, and that's what it's all about.
Okay. Does anyone from the floor have any questions for our experts up here? No?
I have one for John. John, what keeps you awake at night at the moment? Like, what's your biggest, from looking at your business, is there one thing, not necessarily credit focused, but is there anything that keeps you awake?
Yeah, probably the industry will change. I think that's our biggest concern. What does the industry look like in 5 years' time? We're down with the Productivity Commission in Victoria tomorrow, and a lot of their questions are about what is the building industry going to look like in the next 5 years? How are we going to get productivity back into it? Where are trades going to be? So the changing landscape of where we are is rapidly increasing, I think.
A good comment. I mean, if we're thinking about obviously the landscape changing, I mean, from everyone's perspective, as credit professionals or people within this building construction space, like what's a tip or what's a practical thing that we should be suggesting everyone do? What about you, John? Like, what do you think is changing? What do the members need to be thinking about?
It's difficult because I don't think we know what this is going to look like. Obviously, as I said, you've got these land lease communities really starting to take off. Is that going to mean that we're moving away from contract build? What is the channel to market going to look like? If we do go to factory build offshore, then products aren't going to be made here. They're going to be made offshore. So are you going to be dealing with contract builders? Are you going to be dealing with land developers? We've had insurance companies come and see us, superannuation companies say, how are we going to build houses in the future? Can you assist? We can't build units anymore. How are we going to build houses? I think we're facing a dramatic change in our market. There was, we had a futurist came and talked to us recently, a while ago, and he said they took a photo on 5th Avenue in 1900 and there were horses and carts everywhere. Took the same photo 5 years later, there were no horse and carts, it was cars. So what were the people doing who were making horse and carts? So I think how am I going to make a better wheel? How am I going to get cheaper timber? Not knowing that it wouldn't be like that in 5 years' time. So we're moving that fast now, I think, that there's going to be a dramatic change to who we're giving credit to and how we deal with them.
I've got a question for you too. Obviously we're behind in terms of the number of houses or dwellings that we're able to build just for the people that we have here at the moment, let alone the immigration and the things that we obviously need to do as a country to make sure we're continuing to grow. How the hell are we going to ever build enough houses for people to actually live in?
It is going to be, it's either going to be component built or factory built. I tend to think it'll be component built. We see in Japan, they build volumetric, in other words, they build rooms and take them to site. Here, I think, because we've got such a big landscape, we'll go to modular build, and that'll be the change. We see that in China, where with a modular build, they can finish a house in 24 hours and deliver everything to site, get it put up, it's done. So I think they're the changes that are going to... and if we go to that, then we will build more houses. Yeah. And we need to do it. And I think that's why the Productivity Commission is starting to look at this now and say, well, what is this going to look like? How do we deliver those 500,000 houses we need? We're not going to do it how we've done it in the past.
Yeah.
My question is, are groups like yours able to put pressure on any government groups to reduce the cost of the red tape around releasing land? Because that's a big component of the price of housing.
Well, you've seen... Look, I think we've done a lot of work with the federal government, tried to talk to them about, can we change the depreciation regime? Can we look at taking GST off housing? Because obviously there's a multiplier effect if you get houses built, so there's more money in the economy. But they seem reluctant to look at that. You're hearing talk about taking stamp duty off. I agree, land is the big one. So I think the L&P came out recently and said their target was to put $5 billion towards land developers, and either they're going to develop the land or they'll get someone else to do it. So the government's got a lot of land. They've talked to us a bit about, could we just go and develop that ourselves and get the land out there? And they probably need to do it. I mean, the consolidation that's happened with Lend-Lease and Stocklands probably isn't good because they control too much of the land bank now. And really, are they going to be the builder in the future?
It's also all the council plans.
Yeah. Well, it is, but how do you stop that? They're saying they'll take it away from the councils, but the councils probably need that money to survive. If you go back again to the 70s, when you developed land, the council put in the sewerage and water. Now the developer's got to do it, but they still charge you for it. So this model's got to change because we're too expensive for what we're building houses at.
Do we as Australians have to adapt to these Japanese lifestyles of living where you've got more than one generation under the one roof to cater for this?
Oh, look, I think
Growing population?
could be. I mean, it's obviously if you go to a land lease community, you're renting the land but paying for the house, so your debt is lower. So there's that opportunity maybe, and there's a lot more talk about that being the model. So we know there's a lot of big companies out of America and now looking at what they would do with land lease here, which they do in the States. So that would mean you could buy a cheaper house, but you're stuck with renting the block of land. So
I was also led to believe by my nephew in Melbourne last week that in Victoria, and we look now, Rob, I think when I go up, you can actually, as a first home buyer, come up with a certain percentage for the house and land, and the government will put in money and basically loan you some money to be able to buy the place. They then have a percentage, it's up to 30% they'll own your place.
yeah.
And at the end of the time that you've paid your mortgage, you then start paying them off. Now, I was told it's interest-free. I can't see a government doing that. But is that something that should be looked at?
It could be. I mean, I think part of that scheme was they were looking at the government would pick up the capital growth in the property, but not charge interest. So when you came round to pay the government back, it was going to pay. You had to pay today's price. So they'd pick up the capital growth. We've talked to them a lot about that. Is there an opportunity to go around that way? But again, I don't have a lot of faith in the government at the minute. Either side. I'm not saying I don't care about which government we have, but we're not seeing a lot of thought go into it.
Any final comments or questions? Andrew, anything final? Or Rhys?